Hey everyone, and welcome to another deep dive. Today we're going to be tackling something that I think a lot of people find pretty confusing: credit scores.
Yeah, definitely a topic that can cause some head scratching for sure.
Whether you're thinking about buying a house or a car,
Yeah.
or just generally trying to be responsible with your money, credit scores are always there, kind of lurking in the background. So we did a deep dive on a podcast called Finance Unfiltered to try and demystify this whole thing, and they had some really interesting insights. I think we should dig into.
Yeah, absolutely. One of the things that really struck me is how much power this, seemingly simple three-digit number actually has. I mean, it can determine whether you get a loan, what interest rates you'll pay, even if you can rent an apartment. It's kind of crazy when you think about it.
It is. And the funny thing is, or maybe not so funny, is that it's not always super intuitive. Like the podcast pointed out, having no debt at all can actually hurt your score. You'd think being debt-free would be like the ultimate financial goal. But apparently, lenders want to see that you can borrow and repay responsibly over time. So like a blank slate doesn't give them much to work with.
Right. It's like they need to see evidence that you can handle debt before they're willing to give you more debt. It's a bit of a catch-22.
It is for sure. But okay, so before we get too far into the weeds here, let's take a step back and define what we're actually talking about. What exactly is a credit score?
Well, basically, it's a snapshot of your financial trustworthiness as seen by lenders. It's a three-digit number, usually falling somewhere between 300 and 850. And that number basically sums up your entire history with credit. The higher the number, the more trustworthy you appear to potential lenders.
Okay, so higher score equals lower risk for lenders, which then translates into better loan terms and interest rates for us.
Yeah.
Makes sense. But how do they actually come up with that number? Like, what factors go into calculating a credit score?
There are 5 main factors, and I love how Finance Unfiltered put it. They said it's like, be in debt but not too much for a long time, but don't ask for more. It's this crazy financial balancing act.
Yeah, that's actually a pretty good summary of this whole credit score thing.
Yeah.
All right, so let's break down those 5 factors. What's the first one?
The most important factor is your payment history. This accounts for about 35% of your overall score. Basically, lenders want to see that you pay your bills on time consistently. Even one missed payment can have a negative impact.
Okay, so no missing those deadlines.
Yeah.
Set those reminders, automate those payments, whatever it takes.
Yeah.
Got it. What's next?
Next up is credit utilization, which makes up about 30% of your score. This one's all about how much of your available credit you're actually using. Think of it like a gas tank. You don't want to be running on empty all the time. Aim to keep your credit card balances below 30% of your limit. So if your credit limit is, let's say, $10,000, try to keep your balance under $3,000.
So don't treat your credit limit like a spending target, more like a safety net. Got it. What else do we need to know?
The third factor is the length of your credit history, which accounts for 15% of your score. Basically, the longer you've been using credit responsibly, the better. It shows lenders a pattern of reliability.
So that old credit card from college that I haven't used in years could actually be helping my score.
It actually might be. Closing old accounts, even if you don't use them, can shorten your credit history and potentially hurt your score. It seems counterintuitive, but yeah, it's true.
Oh, interesting. Okay, what about the last 2 factors?
So the fourth one is new credit, which makes up 10% of your score. Opening too many new accounts in a short period of time can make you look risky to lenders. It can signal financial instability or desperation.
So resist those tempting store credit card offers, no matter how good the discount is.
Exactly. And then finally, we have credit mix, which also accounts for 10%. This one's all about the variety of credit types. You have like credit cards, installment loans, mortgages, and so on. Having a mix of different types of credit shows lenders that you can manage different kinds of financial responsibilities.
So it's kind of like diversifying your investment portfolio, but for credit.
Yeah.
Okay. I think I'm starting to get the picture here. But who's actually keeping track of all this data? Like, who's calculating these scores and deciding what goes into them?
That's where things get even more interesting. In the U.S., we have 3 major credit bureaus that collect and maintain all your credit information: Experian, Equifax, and TransUnion. Finance Unfiltered had some pretty funny nicknames for them.
Oh, yeah, I remember they. Like the one that sounded like a failed startup or something. It's crazy how much power these companies have over our financial lives.
It is, but here's the thing. They don't actually calculate your score themselves. That's done by companies like FICO and VantageScore using data from the bureaus. So there are multiple entities involved, each with their own methods.
Wow, it's way more complicated than I realized. Okay, so we've got these bureaus collecting data and these scoring companies crunching numbers. But what does it all mean for us? Like, what are the actual pros and cons of this whole credit score system?
Well, on the plus side, credit scores provide a standardized way for lenders to assess risk. It helps them make informed decisions about who to lend to and what interest rates to offer.
Yeah, that makes sense from the lender's perspective. But how does it benefit us as borrowers?
For consumers, a good credit score can open doors to better interest rates, more favorable loan terms, and greater financial flexibility overall. It can save you a lot of money in the long run.
Right, like getting a lower interest rate on a mortgage could save you thousands of dollars over the life of the loan. But the podcast also mentioned some downsides to this whole system.
Oh, yeah, definitely. One major criticism is that credit scores don't consider your complete financial picture. They mainly focus on your debt history, which can be misleading.
Yeah, like we were saying earlier, having too much debt can hurt your score, but so can having no debt at all. It's a real catch-22, especially for young people or those new to the country who are trying to build credit from scratch.
Absolutely. And even small mistakes, like a single missed payment, can stay on your credit report for years, impacting your score long after you've learned from that experience.
So it's not a perfect system by any means.
Okay.
Okay, before we move on, I have to share some of the crazy credit score facts that Finance Unfiltered dug up. Did you know that you probably have like 50 different credit scores?
Really? I had no idea.
Yeah, it turns out different lenders use different scoring models based on what kind of loan or credit you're applying for. So there's no one magic number that represents your creditworthiness across the board.
That's fascinating and kind of unsettling, like having multiple versions of yourself running around in the financial world.
Exactly. And here's another one. Your employer can actually see your credit score. They can check your credit history, which includes things like late payments or collections, but not the actual three-digit number.
That's good to know. I always wondered about that. It makes sense that they wouldn't have access to the specific score, but would still want to understand your financial habits.
Right. Okay. And one more mind-blowing fact. Closing a credit card, even one you don't use, can actually lower your score.
Wait, seriously? Why would that be?
Remember how we were talking about the length of your credit history being important? Well, when you close an account, it shortens that average length, which can negatively impact your score. So even those dust-gathering cards in your wallet might be doing you a favor.
Wow, that's completely counterintuitive. It seems like this whole credit scoring system is full of these weird quirks and loopholes.
It really is. And to top it all off, did you know that bad credit can even impact your dating life?
You're kidding, right?
Nope. Apparently, some people use credit scores as a measure of responsibility and stability. They might actually check their potential partner's credit before getting serious.
Wow, I never thought of that. I guess love may be blind, but credit scores definitely aren't.
Exactly. So it's clear that credit scores have a huge impact on our lives in so many ways. Even beyond getting loans or credit cards, it really is a powerful system with both benefits and drawbacks.
It is, and understanding how it works is essential for everyone, both to take advantage of its benefits and to avoid its potential pitfalls.
Absolutely. So
Yeah.
given all this information, what's the most important thing for our listeners to remember about credit scores?
I think the key takeaway is this. Credit scores are a tool, not a defining characteristic. They don't tell the whole story of your financial health, and they certainly don't define your worth as a person.
That's such an important point to remember. It's easy to get caught up in the numbers and forget that they're just one piece of a much bigger picture.
Exactly. The most important thing is to use credit responsibly, pay your bills on time, and build a positive credit history over time.
So don't panic if your score isn't perfect. It's a journey, not a destination.
Absolutely. And there are concrete steps you can take to improve your score over time.
We'll delve into those strategies in the next part of our deep dive. But for now, I want to leave you with this thought. If credit scores are so influential yet flawed, what alternative systems might be more fair and comprehensive in assessing someone's financial health? Something to ponder as you continue your own financial journey.
That's a great question, something we should all be thinking about.
We'll be back soon to continue our deep dive into the world of credit scores. Until then, keep learning, keep exploring, and keep those credit cards in check.
So welcome back to our deep dive on credit scores. You know, we ended last time talking about how maybe there are better ways to think about financial health than just this credit score.
Yeah, it's definitely a big question. But for now, I think we should probably stick to what we can actually control within the current system. Like, what are some things people can actually do to improve their credit scores?
Yeah.
Because like we've been talking about, these numbers really do have a big impact on people's lives.
Absolutely. And the good news is that, you can actually take concrete steps to build and maintain a good credit score. It's not about, quick fixes or anything. It's more about like building those good financial habits over time.
Okay, so let's get practical. Where should people start? What are some of the most effective ways to boost that score?
Well, first and foremost, pay your bills on time every single time. I know it sounds simple, but it's really the most important thing. Remember, payment history is like the biggest factor in your score. Set reminders, automate payments, whatever you got to do to avoid those late fees and negative marks on your report.
Yeah, consistency is key. What else can we do?
Another big one is keeping your credit card balances low. We talked about credit utilization earlier, remember? Try to use no more than 30% of your available credit on any given card. So for example, if you have a card with a $5,000 limit, try to keep your balance under $1,500. Maxing out your cards all the time can make you look like a higher risk to lenders.
Got it. So treat that credit limit like a ceiling, not a target. What about those old credit cards? We were talking about that earlier. Should people close them or keep them open? I'm still a little confused about that one.
Yeah, it's a tricky one for sure. Closing an account can shrink your overall credit history, which can hurt your score. But on the other hand, if you're worried about having too much available credit and maybe overspending, then closing some accounts strategically might be a good idea. It really depends on your individual situation.
Okay, so finding that right balance is key. Any other tips for someone trying to improve their credit score?
Oh yeah, definitely check your credit report regularly. You're entitled to a free copy from each of the three major bureaus every year. So that's Experian, Equifax, and TransUnion. Go through them carefully. Look for any errors or inaccuracies and dispute anything that seems wrong. You'd be surprised how often mistakes happen.
Wait, really? Errors on credit reports?
More often than you think. It could be something small, like a misspelled name, or something more serious, like a payment incorrectly marked as late. But even small inaccuracies can drag your score down, so it's important to stay on top of it.
Wow, so it's like a financial health checkup. We should all be doing that regularly.
Mhm.
So if we do find an error, what's the process for disputing it?
It's pretty straightforward, actually. You just contact the credit bureau directly and provide documentation to support your claim. They're legally obligated to investigate and correct any mistakes.
Okay, good to know. What about people who are new to credit or have a limited credit history? Any advice for them?
Yeah, a secured credit card can be a good option. Basically, you put down a security deposit, which becomes your credit limit. It's a good way to start building a positive payment history and show that you can use credit responsibly.
Makes sense. Now, what about people who have maybe made some mistakes in the past, like late payments or even a bankruptcy? Is there any hope for them to rebuild their credit?
Absolutely. It takes time and effort, but it's definitely possible. The key is to show consistent, responsible credit use moving forward.
So it's about proving that you've learned from your mistakes and are making better financial choices now.
Exactly. And remember, those negative marks will eventually age off your credit report. It might take a few years, but they won't be there forever.
That's good to hear. So what are some steps people can take to rebuild their credit after a setback?
The most important thing is to make all your payments on time from now on. That shows lenders that you're serious about meeting your financial obligations. Consistency is really key, especially when you're trying to rebuild.
Consistency seems to be a big theme here.
Yeah.
So even if your credit took a hit in the past, staying on track with payments can really help.
It definitely can. And if you're having trouble keeping up with debt payments, don't be afraid to reach out to a credit counseling agency. They can help you create a budget, negotiate with creditors, and explore options like debt consolidation or debt management plans.
That's good advice. Now, we were saying earlier that credit scores don't tell the whole story of someone's financial health. What are we missing when we focus only on this one number?
Yeah, that's a crucial point. Credit scores are really just looking at your debt history. They completely ignore things like your income, your assets, your savings, even your financial literacy.
So you could have great credit score but be living paycheck to paycheck with no emergency fund. Or you could have a low score but actually be managing your money responsibly in other ways.
Exactly. It really highlights the need for a more holistic view of financial well-being.
So it sounds like there's a need for more data points in these assessments.
Absolutely. There's growing awareness that credit scores are just one piece of the puzzle. They're useful, but they shouldn't be the only factor determining your financial worth or opportunities.
Okay, so what else should we be considering when evaluating our overall financial health?
Well, it's important to develop good financial habits across the board. Create a budget, track your spending, set financial goals, build an emergency fund. These are all essential steps towards achieving financial security regardless of your credit score.
So it's really about taking charge of your finances and building a solid foundation.
Exactly. And it's an ongoing process, not a one-time fix. You're always learning, adapting, and refining your approach.
That's a great way to look at it.
Yeah.
We've been talking a lot about how credit scores work and how to improve them, but now I want to zoom out a little bit and think about the bigger picture. How does this system impact us, not just as individuals, but as a society?
That's a really important question and one that often gets overlooked. The credit scoring system as it exists today can actually perpetuate existing inequalities and create barriers for certain groups.
How so? Could you give me an example?
Sure, imagine someone who's new to the country or comes from a community that hasn't traditionally had access to banks and financial institutions. They might have a limited credit history even if they're financially responsible, and that can make it much harder for them to get loans, rent an apartment, you name it.
So their credit score might not accurately reflect their actual ability to manage money. It's not a level playing field for everyone.
Exactly. It really highlights how systemic factors can influence credit scores and create these disparities.
So it's not just about individual choices. There's this whole societal context to consider. Are there any solutions to this problem? Like, what could a fairer system look like?
That's a big question, and one that we'll dive into more deeply in the next part of our deep dive. But for now, I think the key is to be aware of these challenges and advocate for a more inclusive financial system.
So we need to move beyond simply accepting the current system and start pushing for something better.
Absolutely. By understanding the limitations of credit scores and their broader impact, we can become more informed consumers and advocate for a system that works for everyone.
Okay, so we've talked a lot about how credit scores work, how to improve them, how to rebuild them. But as we head into the final part of our conversation, I want to leave you with a question to think about. If we could redesign the credit scoring system from scratch, what would it look like? What factors would be most important? How could we make sure it's fair and inclusive for everyone?
That's a great question. It challenges us to think critically about the current system and imagine something better.
Exactly. We'll be back soon to continue our deep dive and explore some of those potential solutions. But for now, keep learning, keep questioning, and keep striving for financial well-being. Welcome back to our deep dive, everybody. We've been talking all about credit scores, the good, the bad, the ugly. And last time we ended on a kind of a big question, right?
Yeah, you challenged us to think about redesigning the whole credit scoring system from scratch. Like, what if we could rebuild it with fairness and, a more holistic view in mind?
Exactly. Because as we've seen the current system, it's got some serious limitations. It doesn't really capture the full picture of someone's financial life. And it can actually end up reinforcing inequalities. So where would we even begin with this redesign? Like, what would be the foundational elements of a more just system?
Well, I think the first step would be to broaden the scope of the data that's being considered. Right now, it's so heavily focused on debt. But what about incorporating other financial behaviors that show responsibility? Things like income savings habits, consistent rent, or utility payments, those could all be really strong indicators of financial stability.
Yeah, it's like the current system almost rewards you for being in debt, as long as it's not too much debt, which is kind of backwards when you think about it. What if we flipped the script and started rewarding positive financial actions, whether or not they involve borrowing money?
Exactly. Imagine a score that takes into account things like how well you budget your saving rate, even your financial literacy.
So it becomes less about how much debt you have and more about how you manage your money overall.
Right. It's about painting a more complete and nuanced picture of your financial health. But even with better data, we have to be really careful about potential bias. Algorithms are created by people, and people can have conscious or unconscious biases that can creep into their creations.
That's a really good point. How could we address that in this redesigned system? How do we make sure that those biases aren't negatively impacting certain groups of people?
I think transparency and oversight are key. We need to have very clear and understandable criteria for how the score is calculated. And those criteria need to be regularly audited for fairness. No more black box algorithms.
So people should be able to understand how their score is being generated and have the right to challenge it if they think it's inaccurate or unfair.
Exactly. Giving consumers knowledge and control over their own financial data is absolutely essential. But we also have to remember that credit scores are used to make some pretty big decisions. Getting a loan, renting an apartment, even job opportunities can depend on this one number.
All right, we can't forget about the human element here. So what kind of safeguards would we need to put in place to make sure these scores are being used ethically and responsibly?
Well, for one thing, we need to prevent discrimination based on credit scores. Just like we have laws against discrimination based on race, religion, or gender, we need similar protections when it comes to credit. Your score shouldn't be used to unfairly deny you opportunities, especially in areas like housing or employment where it's not directly relevant.
So it sounds like we're talking about a pretty fundamental shift in how we think about and use credit scores. This all sounds great in theory, but is this kind of radical change even possible in the real world?
It might seem radical, but I actually think it's necessary. And the good news is that it's already starting to happen. There are companies and organizations out there developing alternative credit scoring models, models that incorporate some of the ideas we've been talking about. And as more people become aware of the flaws in the current system, I think we'll see even more momentum for change.
That's really encouraging to hear. It gives me hope that we can create a more equitable and inclusive financial system for everyone. But in the meantime, while we're working towards that future, what can our listeners do today to navigate the current credit score system in a way that empowers them?
I think the most important thing is to become informed. Learn how the system works, understand your rights as a consumer, and know the steps you can take to build and maintain good credit. Don't be afraid to ask questions and challenge assumptions and advocate for yourself.
It's about taking ownership of your financial journey, understanding the tools that are available to you, and making choices that are aligned with your own goals and values.
Exactly.
Well, we've covered a lot of ground in this deep dive. We've explored the ins and outs of credit scores, talked about their limitations, and even imagined a better system. But the key takeaway here is this. Credit scores are powerful, but they're just one data point. They don't define you as a person, and you don't have to let them control your life. It's all about building healthy financial habits, advocating for yourself, and working towards a more equitable financial system for everyone.
Couldn't have said it better myself.
Well, on that note, I think we'll wrap up this deep dive into the world of credit scores. Keep learning, keep questioning, and keep those credit cards in check.
If this podcast helped you, don't forget to like, comment, and subscribe. Your support helps us keep making these videos. Thanks for watching.